Are you intrigued by the concept of wealth efficiency like I am? If the answer is yes, then keep watching because today we're going to delve into the exciting world and how it can lead to significant tax savings. Hello, I'm Kyle Sadler, President of Precept Wealth Management and best-selling author of I'm Retired, Now What? And The Retirement Shift, now in second edition. Recently, I attended an enlightening wealth efficiency workshop. What blew me away was learning how financial professionals have been helping clients save over 75% in income taxes on average. Sounds impressive, right? But implementing these strategies has its challenges. The biggest hurdle, client apprehension. Some folks are understandably wary about being sold something. But here's the funny part. A lot of times there's nothing actually to sell. Most of the time, clients already have what they need to get started, and the process doesn't usually involve any additional cost. So you may ask, Kyle, how do I begin my journey to wealth efficiency? Firstly, check if you have a cash value life insurance policy like a variable universal life, or whole life policy. Now, term insurance policies do not apply here. But if you do have one of these cash value life insurance policies that I have previously mentioned, please send me the declaration page and I'll gladly review it. Secondly, do you have a Roth IRA that I'm not currently managing? If so, let me take a look at a statement and I'd be more than happy to give you an idea of what we're looking at. Lastly, if your kids have any of the above and are interested in planning for retirement efficiency, I can show them how they could possibly save a whopping $350,000 to over $500,000 in income taxes after retirement. Encourage them to connect with me immediately. The key to this strategy is maximize distribution income in retirement and minimize the tax burden. The goal here is to identify those who possess the foremost mentioned assets. Once identified, let's say a retiree has an IRA, a 401k, a Roth IRA, and a cash value life insurance policy. Now, inefficient wisdom and sometimes even financial professionals will only take a distribution from, let's say, an IRA or 401k. So just for an example, a person takes $150,000 a year from their 401k and or IRA. They will pay approximately $23,600 in income taxes. However, if the same person came and did proper pre- and post-retirement planning and developed an income strategy as I'm covering today, what if they supplemented a portion from their Roth, their variable universal life, their wealth efficient brokerage account, etc.? So this brief example, they may only pay approximately $5,500 in income taxes. Now, multiply that difference of planning versus not planning over 20 years of retirement. Yep, that's $362,000 that went to unnecessary retirement income taxes. Would you like an extra $362,000 back in your pocket to assist with your retirement? What about other consequences out there? The Medicare income levels, the taxable Social Security income. Yep, it's time to give me a call. Now, always remember that wherever you are today, whatever age, look at ways that you can increase the amount you're saving. Now, having a plan can help tremendously and changes can be made more easily. Do you need assistance or want a second opinion of your plan? I'm only a phone call away. Call me at 281-973-9290. Again, that's 281-973-9290 so we can discuss further. I'm Kyle Sadler asking you, please don't forget to like and subscribe by hitting those beautiful buttons below. And thank you very much for watching. Stay cool, stay awesome, and be blessed.